This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds to give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. We're excited to announce that we'll be partnering up with MicroCap Club for our full slate of investor conferences in 2025. Ian Castle and his team at MicroCap Club have not only built and fostered the best community of microcap investors, but it's arguably one of the best investing communities, period. We couldn't be more thrilled to leverage our expertise in curating and hosting large-scale microcap conferences and teaming up with MicroCap Club to put together world-class conferences for the microcap community. First up, the Planet MicroCap Showcase Vegas in partnership with MicroCap Club will be held on April 22 through 24, 2025 at the Paris Hotel and Casino in Las Vegas. Registration is now live. Please visit planetmicrocapshowcase.com for more information. See you in Vegas. My guest on the show today is Maj Soueidan, founder and editor at Geoinvesting.com, as well as MS MicroCaps. 2024 is in the books, and like every good podcaster, we had to do our version of a year-end review. And in the microcap world, there's no shortage of things to cover. So much so that this might be Maj and I's longest pod ever, an hour and 40 minutes worth of mostly what I think we do best, a jam session on microcap stocks and investing. Maj absolutely cooks on this episode, and it's always fun to watch. We dissect defining quality, round trips, unexpected winners, information arbitrage, growth capital, how diversification can allow you to concentrate, and much more. We discussed a number of stocks during our interview today, and for full disclosure, I am not a shareholder in any of them, and Maj also may or may not own the companies that comprise their tier 1 quality microcap index. Please see MS MicroCaps and Geoinvesting for full disclosure. Thank you again for tuning into the Planet MicroCap podcast and for all of your support in 2024. From all of us, I'd like to wish you a very happy holidays, happy new year, and I look forward to seeing you all in 2025. With that, please enjoy my conversation with Maj Soueidan. Maj, happy new year, brother. I mean, we're not there yet. We're recording this on Friday, December 27th, but happy holidays. We'll start with that, and then we'll go to happy new year, but good to see you, man, as always.
Yeah, well, thanks for not calling it Miss Cliff Notes like you usually do.
Well, you did tell me offline that there might be some changes in the making it, but I miss microcaps. It's just I really hope you don't change it. It is
We believe in diversity here.
Yes, so. This is a very inclusionary podcast, especially since unfortunately we love for more folks to be in microcaps, but so to make up for it, we're just going to keep Miss MicroCaps and go from there.
All right, cool, man. Cool. Let me go through the terms and the disclaimers and stuff real quick here.
All right.
And
then I'll give a quick outline because I have a feeling, look, whenever we record, I always just say however long these things go, they go, because, we literally could talk for hours about all this stuff. I usually end up setting aside like 4 hours for any recording that we do because there's so much to cover just in any given week. But since this is our official end of year Planet MicroCap podcast pod, I figured, oh man, this might be in for a barn burner. If you guys are going, I would recommend if you're going to go for a run, do like a 50K right now because, okay, I don't want to set too long.
You did say you got all day, so you set me up. So you eat your words now.
This is true. Hey, listen, it's as long as this coffee will take me. That's it. But
I'll try and keep it quick. Though, but I'll try and stay within the hour. You make me stay in usually. But
no. We can go over the hour. We'll be fine. But just to give everybody like a little setup of what we're going to do today, of course, we want to do kind of a year-end pod. Everyone does a year-end pod. We're no different. We're not original, so we're going to do one too. Kind of talk about the year that was, all the different things that happen that we can hopefully remember. Just we're going to talk about a few of Maj's posts that I think are very relevant to a year-end pod, specifically talking about, we've done some M&A stuff. Shout out to Matthew Martin, who's been just on it on the Canadian front, as well as post-election round trip, maybe the year ahead, spotting the real winners in a game of hype, looking specifically at drones, AI. I think a fun topic that Maj and I were just talking about online is about how you don't always know what your winners are going to beat. So we have a lot to cover here today. So I think first Maj is going to do quick run through of some performance from the MSMqi. That's the index run over there at MS MicroCaps, aka MS MicroCaps, and how it's performed against some of the other indices to give you kind of a better reflection of what's going on in the small microcap space. And then we'll go from there. So if you're watching on YouTube, you'll be able to see this. If you're listening in, we'll do our best to kind of, articulate what we are going through, but I invite you to go and check this out on YouTube as well. So with that, Maj, take it away. Give us the full recap here.
Yeah, cool. And then there'll be some, since we're not quite towards the end of December yet, we got a couple more days. There'll be some November stuff in here too. So the stats might change between now and the end of the year if we have a big crash on Monday or Tuesday. That's why I'm glad we're doing it now. But to get those stats in, baby. But
hey, the round trip's already happened, bro. We're how much worse? Famous last words. How much worse could it get? I don't know.
That's right. I'm getting over a little cold here, so you might hear me cough here and there. I'll try and control that. But terms and conditions here, as Geo, MS MicroCaps here. We're not investment advisors. Just want to let you know, everybody watching this, that you agree with our terms and conditions that you can see on the respective websites. However you're consuming this, whether you're reading it, or listening to it, or however you're viewing it or consuming it, you agree with our terms and conditions. All right, so I'm going to go as quick as I can here by through the performance stuff so we can get into some of the good topics we want to talk about. And as we go through it, we'll talk about some stocks, I'm sure. But I don't have quite all December's returns yet, so I want to show you November's returns, which was a good month for market in general. But really, my whole focus really here is to show you between MS MicroCaps, and I have some Geo stuff too on here that shows you how quality is really driving some of these returns. And I've been waiting for this for a long time to occur. And you and I have talked about it for a long time. My first 20 years of investing was really more GARP-ish in general. I don't want to say, I hate putting labels on things, value, whatever. But, and looking for, high quality companies or those moving to high quality and then high probability turnarounds. And as you remember, we go through this period of easy money, in 2008, 9 to 22. I had it was okay, but it wasn't working like it used to work for me. And now I think we're back in the environment, which really helped me my first 20 years because of higher normal rates. And so I think it is going to be a very interesting period of time. And I think since 2022, we've been seeing that shift of really this GARP-ish or high quality nano cap, microcap, starting to really perform and outperform the indexes finally, like they hadn't been doing in a broad fashion the prior, 15 years or so. So these returns continue to show that. If you look at November, we were up. It was a record month for the index. Our index basically is on the Substack, MS, the Cliff Notes Substack. And I'm gonna laugh.
We won't keep doing that
every time.
Yeah, I know, right? We won't keep doing that. Let's be grown-ups, okay?
Yeah. So what we do is we have like a checklist of quality factors and a checklist of multi-bagger factors, and then when those combine in the 10,000 stocks, there's 10,000 smaller caps, microcap stocks in North America, U.S., Canada. We monitor about 1,000 to 2,000 of them, and the ones that are hitting quality factors or moving towards there and multi-bagger factors make it into the index. So it's a little quantitative, qualitative analysis. So that's how we build the MSMqi, which stands for MS MicroCap Quality Index, and the M stands for momentum. We're looking for stocks that can have momentum and price, and the S stands for sustainability and business. So it's a all right,
okay.
Thing.
That's another hilarious part is that it.
I know what you're thinking.
Well, it should be your name.
It's just a coincidence.
It's just right. Okay, got it. Okay, sorry. Oh my
Yeah.
gosh.
Come on. My
This,
ego wasn't that
you know
big.
what? This should just be a Maj roast. I don't know what we're doing, talking like seriously right now.
You'll
This.
never know. You'll never,
Listen,
never really
listen.
know
We
what
all
happened.
know. Listen, I think we can all agree Maj is the best marketer out there. I don't think there is.
I'm a horrible
He
marketer.
is the hands down the best.
And hence miss. Yeah, that was a great. That was
Like that's even better. It's not even for Maj Soueidan. No. It's for it's momentum and I can't remember the other one because I'm laughing too
sustainability
hard.
business plan.
Oh, sorry, sustainability. Excuse me. Oh my gosh,
Yeah.
dude, that's so funny. Oh, I
It
love
was
it.
working though.
Yeah, it's working. Yes, it got
So,
protected.
so anyways, we have so for November, the index was up 18.9%. You know, and that was really a good month for the iShares MicroCaps up 11.48%. So we were pretty happy for beating that index. And of course, we beat the S&P, which came in at 7.93% for the month, and Nasdaq was 8.14% for this month. By the way, in December, we're kind of flattish. We haven't really we had a little bit of pullback, but we're still in the same. Came back, we're still in the same area. I think that's the overall kind of trend in December anyway. Move over here. This is the graphical representation of how the index has done since we launched it in February 22. On average, that's 87.25% over that time. It's been the return of the stocks in the index versus, as you can see, the S&P at 45.89%, NASDAQ 39.35%, and the iShares MicroCap average of 12.63%. Again, showing that quality in this. The strategy's working to some, to some degree, at least for now. Who knows how long it will last? I think I told you, Bobby, like, we do expect this index to get crushed at some point. And I have seen glimpses of it when the market's falling, but we have seen this thing really. You don't see it on the end of year totals, but it is gonna, my goal with the index really is, can it crazy outperform the market in good times? Because over time the market does go up, so I don't care. And in downturns, is it going to, be worse than the index sometimes? Probably at times, but since long term market goes up over time, I'm really more concentrated on getting really this juicing those returns when the market's doing well, because overall
Interesting.
that's what's going to matter to us.
I'm super curious how the December returns are going to look. I mean, we'll get to this topic of soon.
Yeah.
But
I that's so now you set me up. We'll see if I have those.
I said we're going to be on here for 4 hours. I don't know. Let's Jan, let's go.
So we look at the year. So we look at year-to-date performance. We looked at the overall and the month of December, month of November. But year-to-date, we're still doing pretty good. The year-to-date return is 58.42% versus the S&P of 31.1. NASDAQ 30.5, and the iShares MicroCap 18.59. So we're still beating it there. There's about on the November returns, there's 103 stocks. In December, we added, I think, 3 more stocks. Now we're at 105 stocks in the index. So this is a very passive index, by the way. We don't even rebalance it right now. And I'll get to that in a little bit. This is just taking away behavioral analysis. We want to see if the strategy can work. We can live in the bed we're making here, or sleep in the bed you're making, because whatever that term is. And so even if there are some stocks that maybe aren't doing so hot, I want to let them marinate just to see how it all works out. So maybe they're not doing good now. I'm going to show you some when we go to the returns. I'm going to show you stocks I would have removed if I was actually actively managing this index, and show you how knucklehead of a move it would have been. So, and you'll like that, of course. Another roast moment for you.
No, you're in the arena, bro. I won't roast you for being in the arena.
So really, what I wanted, we set a goal when we launched this thing is, and by the way, every stock we add the index comes with a cliff note. Yeah, so you know why we're adding the index. And so we had a goal, how many multi-baggers can we get to? So we set an initial goal of, hey, let's try and get to like a 30% multi-bagger hit rate and see if that's a good goal. So 30% of stocks that we're putting in there, can we say they at least went up 100%? And at some point in time. And then we decided, we want to elevate that goal to 50%. So if you look at this November spread performance, it shows you the returns within certain um, deciles, right? So the 100% return or more would be a multi-bagger. Currently, there's 27 stocks sitting in multi-bagger status still, but we've had 41 hit the multi-bagger status as of November. And since November, actually, two more have hit KEQU, Kiona Scientific, makes which I do own, by the way, which means lab equipment for schools and libraries and commercial enterprises, universities, and LFVN, which is LifeVantage, which I also own a little bit of that thing. I think still left. I believe I do. And they make actually nutraceutical and healthy lifestyle kind of products. And I want to come back to those two later on, Bobby, so we can we can come back to those, and I want to talk about the information arbitrage kind of setup that both of those presented investors with. And I really want to focus a lot today on InfoArb. I made a goal in 2025. That's going to be a lot of InfoArb talk. You're gonna get sick of hearing about it probably, but today we put out a tweet about InfoArb, and we can break that down too. So that's basically performing. You can see here, 50% of stocks are actually 48% of stocks right now are sitting at 50% returns or higher. 60 the high rate was 65% on that. So you can see that most of the stocks are up. We have here, you know, the 74 stocks or 72% of the index are up. So that's a pretty cool kind of stat, I think, that this index is the reason it's diversified, but the reason it works, I think, or at least for now, is that we have just a high hit rate of positive returns. That's why diversification is working here, I think.
Man, I think you're underselling it. A high hit rate. I mean, just based on this with 102, like you had nothing that had negative performance this year, if I'm reading this correctly. Is that true?
Well, you do have some. We have let's say we have
or less than 0%.
No, 0%, yeah. So yeah, I mean, I think
greater than. Oh, okay.
Actually, is that? Let me look at that real quick. Less than greater is less. That can't be right.
Yeah, because that would mean that
because at some point because when you start the index, I guess that's what we got to actually probably. I will tell you, there's about 25 stocks in negative territory.
Okay.
Out of the 105 or so.
Got it. Okay.
Yeah.
By the way, I'm waiting for another new newsletter for you to launch next year on InfoArb.
I was thinking about that actually. It's so funny you say that because we were talking about that.
That should be the fun. That's always been like whenever I think of Maj, like that's always been the thing I think of with you. It's just like you've been so on it with InfoArb, and like that's where you've made your bread. Like that would be cool if that's like that just ends up being your main focus is just InfoArb opportunity. Because that is still to this day. I mean, most folks who are listening to this are active, man. They do the work. You guys are awesome out there reading the Qs and Ks. But for the most part, there's a lot of passive investors. For better or worse, it's up to you. People at the time, the passion, whatever. They don't look at the Qs and Ks. Still, I don't have time to always look at the Qs and Ks.
Right. Well, the thing is, in the smaller cap world, man, it's almost all InfoArb, a lot of it, right? It's amazing how much there is out there.
Yeah.
And it would be an interesting newsletter, one pick a month guaranteed of InfoArb, and make my life a lot easier.
Just do it, dude.
So it is something you're kind of in that. We're experimenting with it actually, so
there we go.
And you'll be the first to know, of course, and we'll talk about it if that occurs.
Let's go. I love introducing new Maj products on here.
And so let's look over here at the spotlight stock. So we went into December a little bit here. So spotlights. So we have this setup where we think the index kind of worked, right? It's working at least. But the next thing we thought about, okay, there's 100, we know this thing's going to grow, and that our subscribers need a little bit of, okay, well, yeah, we can't buy 105 stocks. Can you kind of give us some idea who you like? And we're not a recommendation service. We do understand that need. So we're creating sub-indexes. And the Spotlight Index was the first one we experimented with, which is the closest you're going to get to an active index for us, right? I mean, we're not going to actually manage a portfolio, but it still is a to give you some idea of the stocks we like. And again, it forces us and our team to look at the index and try and really examine every stock in the index and then find some of the better ones to highlight in the spotlight index. And but which is a little bit of a, I should say, we have a tab on the MS Cliff Notes, which has a spotlight index, and you can look at them. But the downfall of a Substack is you can't really build this platform where you have these dashboards of returns in real time going. So that's the one thing we're trying to figure out. But anyways, as you see here, the spotlight these returns, the high return on the spotlights were 52.2%, and then the current return are 34.47%. There's 7 stocks in the index right now, and as you can see, they're beating the indexes that are the 4 from S&P, Russell, iShares, and Nasdaq, anywhere from 15.83% to 22.99%. So they are, and there's 7 stocks in that index right now. So KEQ was, we just added that one, was an InfoR pick actually. It's up 28% since we added it in December. So again, it just continue to prove that we like to say, okay, we're not making recommendations, but we like to say, hey, we give people chances. And that's the thing, I think that's what we want to do. We want to give ourselves a chance to succeed in this environment. And we think the index gets you closer to that point of view. And a lot of our subscribers use the index as a hunting ground. We're attracting those kind of investors. Like to just go there, read the Cliff Notes, connect with them, and decide on their own if they want to buy these or not. But we are trying to make lives easier by breaking down. We're soon about to launch a dividend index, which are all the dividend stocks in the index, for example, which is the next index we'll be launching, which shows you high quality. And the reason to do this also is it just keeps showing that, hey, even the newbies in this space don't get fooled by the narrative that you hear in CNBC or others that there isn't quality in this space. There's a lot of quality. And I mean, we all talk about, Ian talks about it, right?
Yeah.
Paul talks about it. Matteo talks about it. I mean, we're all proving that quality exists. And now the next thing is, okay, did you, a lot of these companies pay dividends. There is cash flow to distribute there to the shareholders, and so it's another
for better or worse in some names, for sure.
yeah.
For one reason or another, I have one at the top of my head that for sure on that. But I see. But you make a good point.
So I want to talk this. Then we can start talking about some of the things you were talking about, like earlier, about how do you round tripping and what do you expect from us, expectations being thrown out the door in terms of what you thought a stock would do. So here are the top, maybe 12 or so stocks in the index that performed. That were really the driver performances that you can see.
What does the date symbolize? Because you have some dates where it's in 2024, others in, like for Hammond 2022. Is that like when you first profiled it on either Geo or you were owner? Can you just clarify that?
Yeah, these are the dates we added it to the index with a cliff note. And I'll get to the Geo thing, how this powers Geo 2 in a second. Some of these stocks also are on Geo 2, but
and also disclose which ones you own.
Oh, Jesus, here we go. Let me see.
Well, you're gonna throw a lot of names. You gotta disclose. Come on,
I'll tell you, I'm long TSS still, long CPHRF with Cypher, long BRMF, long FATCO, long KLNG.
Got it. And then the rest of you are not a shareholder.
Well, no, the rest of I definitely don't own, and I can tell you, regrettably, I don't own them. And that's another thing we're talking. That's another thing I want to talk about with you today. Is like when I look at these returns, and this is even when I go back to my first 20 years of investing. This is the strategy I was actually using to some degree. I just didn't know it in this. I didn't break it down like this as much as I am now, but this is the strategy I used, and I would always be amazed at the end of the year when I would look at my taxes. Oh wow, I didn't think that was the one I made a lot of money on, and you start realizing that some of the stocks, you don't always know which ones, at least in the short run, especially, which ones are going to perform. So when I look at this index here, and you can see TSSI. I had no idea it would make the top. And I even got to tell you this, to be honest with you, when I first bought TSSI, I think it was, we didn't have the Substack yet because Substack was launched in, um, the index was launched in February under a group of investors from Geo of 22. The actual Substack was launched in 24 of February or January. Once we figured out this was working, so that's the progression there. Um, so we go back to TSI, and TSI was really originally a Geo idea. Um, on a model portfolio we have there called the Run to One stocks. Your stocks trading under $1 that we think are just have a chance of eventually going over $1. And I guess it would be similar to Paul and Julia's cheapies with a chance. I think he has one like that. I think he has a pretty cool thing like that. So it's kind of cool because it just flies in the face of all the haters of the space. You want to talk shit about what we're going to show you differently. We're going to show you some of these, like, I mean, ZDPY, medical device company, where that, remember, that one was a 50-cent stock. I mean, we had bought it at Geo when around that time the stock went to, I think, $30. It's a real company. I mean, they got hit by a few short reports along the way, but it's still a real company. So you can find these companies. So when we bought TSI, the TSI is a data center integration company, and when I bought it, it was like, I think, around 20 or 25 cents. And the previous CEO, Anthony Angelini, had been in the company for a few years, turned the company around, and he basically saved the company from bankruptcy. And I found it right at that time, right where they were kind of like breaking out in terms of restructuring the balance sheet and have stabilized the business to a point where they were at least going to get to maybe break even, a chance for profitability. Visited the facilities, they're on Round Rock, Texas, which is outside Austin. And the stock actually went from like 25 cents to, I think, like $1.70 or so from that time, right, I think right around COVID or so. And then what happened, COVID exposed a lot of issues for a lot of companies, and it exposed some issues for TSS, not being able to handle some of the supply chain issues, maybe not being in a position to really scale the business. And basically, I think what COVID did was accelerated those issues that I had, you just don't know about, right, necessarily. And it's not going to total round trip, slow round trip though. It was one of those like watching paint dry round trips, death by 1,000 nails. Is that what they call it, or 1,000 what, needles, or whatever it is?
Yeah, something like that.
Pins.
It works.
I'm really bad with that shit too, by the way. I'll get all those things wrong. All the sayings totally wrong. So,
Listen, as long as you pick good stocks and you're making money, who cares if you're the worst marketer in the world at this point, right?
So eventually it round trips, and it's back to 30 cents again or so. And enter new CEO, Daryl Duan, and I believe he's probably going on 3 years now. I was totally surprised. Wake up one morning, boom, because I used to talk to Anthony all the time. And wow, he'd be right before a call or earnings, he's done. So that was really weird. So Daryl comes in, and you start, during that dating process, you start learning some things. Oh, wow, I didn't know this. I didn't know that. I didn't know, wow. So you sort of learn, wow, there was some stuff going on at TSS that maybe wasn't that freaking great. And it just turned out that my sense, although I don't know this for sure, that the company was very close to being in some massive trouble with its largest customer, because of inability to scale. These are just things I didn't know, right? I just thought they had a great relationship and with them, and Daryl came and fixed that problem. But it just shows that there's so many things that I didn't know that you couldn't predict. You had this big move in the round trip, right? Really not knowing how close they might have been to shutting the doors. They might have been very close. And then Daryl coming in and, okay, all right, he fixed the business to scale it, right? but they got a little lucky. I mean, AI comes in and really transforms some of the narrative. To Daryl's credit it wouldn't have mattered. It wouldn't have mattered though if Daryl wasn't able to get the business ready to go. I didn't know if Daryl was going to do this. I mean, Daryl's coming in as from his past operation, or mainly his sales background. I didn't know if Daryl was going to turn this thing around, right? But I was pretty amazed at how fast he did it, though. So what goes to show is there was a lot of luck there involved. There was a lot of I don't know was involved in what's going on there, and it just ended up working out. So there's no way I would have predicted that this stock would have been $12 today, right? Or would have been the one when I added it to the index in March of 24. I had a good idea that things had changed. So I knew at that point, but I still didn't know it was going to do what it did. And so there's a lot of great things happen. So it's a great example of just not knowing, which is why I like to preach diversification to a lot of newer investors.
To ask you, not to cut you off because that was great, but specifically to your own style when you're looking at a TSSI, because we were joking offline about how there was one stock that you bought at 2 and sold it at 6 and it ran up a couple more, but what was it about TSSI that you were like, all right, just doubled, tripled, why not sell then, not expecting it to continue to go on the run that it did? Just curious what your thought process was.
Well, look, I'm not saying I didn't sell any. I mean, I know there was. I mean, I don't post every trade, but to me, it's like I'll answer this way.
Okay.
That diversification allows me to worry less about myself about that stuff. Diversification allows me to sit there and wait a little longer, but you still have to be able to responsibly, take some money off the table when your stock's going up, of course, right? But because you have this kind of cycle of stocks, this is showing what if you could own every best quality company going through a multi-bagger inflection point in MicroCap world? That's what this is answering. That's the question this is answering, and we're getting here. So my thing is, okay, I might not make the most optimal sell decisions, right? But this is giving me the mentality and ability to think about having a long tail piece of my portfolio where I just hold on for maybe 10, 20 years on some of these things. Because the way this works is you're going to get these great returns on a lot of these stocks. And as long as I always want to I'm going to want to keep a piece of TSI there. I mean, I could change my mind, of course, but just in case. So I mean, it was very, very tough though. Because TSI was very transformational with my portfolio this year. And if I look at my returns, it was the biggest piece of it. At one point it wasn't a big piece of my portfolio. Like at 30 cents, it was nothing. But then it becomes okay, like a bigger piece of my portfolio. 2 or 3, you start worrying, wow, this is, do I want to lock? You start thinking, you have this really behavioral tug of war between, should I keep it, right, analyzing the business, or do I want to lock my returns in? Because that's how our minds think. It was a constant struggle with me, like, okay, I have this return. I still think the business is worth more, but I want to lock these returns in to make myself feel better, right? It was that constant tug of war. And I played it pretty good. I will say that I played this one really, really good. And part of it was luck, part of it was stubbornness, but part of it was having a diversified portfolio, not caring. I put myself into this diversification situation. It allows me not to care as much as about volatility, or care as much as TSI goes down because I got the other stocks coming up, to get support. That's why I like diversification across this whole thing. And I am writing an article about this. I mean, I've been writing it for a long time about diversification versus concentration, and letting diversification lead you to concentration. Just let a great portfolio of the best stocks in the world it'll let you know where you should be concentrated. And it's teaching me, really, I didn't look at it. I never looked at it this way when I was younger. I made a lot of mistakes when I was younger. Had I looked at it this way, I probably would have kept a little bit of Monster beverage. I probably would have kept them. I would have kept some of these stocks. I just was always thinking in the moment, lock the return in, make myself feel good. Boom.
Hey, no one's you're never gonna get mad at yourself for making money, right? At the end of
Don't.
the day, at the end of the end of the day, right?
Correct. But this, but
Sure,
this,
but
but
I
this,
hear what you're
also,
saying.
this allows you to build this really long tail. Okay, you sell, yeah, you own these best stocks. You get all these multi-baggers. Okay, keep about 10 or 20% of your position long term and see what happens.
And
This allows you to have that comfortability. And to me, it's fun. Now, I don't, I'm not concentrating investing. I'm going to show you later some concentration portfolios that do well too. It works, but I enjoy the diversification piece of it most myself. So I do what I enjoy. Some people don't enjoy it.
there's
And
also, would you also say there's some tax implications there as well too when you think about diversification? Because if you're just holding on to a massive winner and yeah, taking a little bit off the table as it continues to go up, I mean, for tax purposes, you're also trying to think like, all right, it doesn't, it's not the worst thing in the world then to have a couple losers here that whether I ultimately sell it or
yeah,
take
yeah,
gains, all that kind of stuff. Like that I'm sure that's stuff that goes through your mind as well. You're like, all right, this isn't the worst thing that this is a dog.
right. That's true. You have they had a luxury of doing that, but also from a tax point of view, it allows me to, if I'm thinking more of this, keeping some longer term, it allows me to have a reduced tax rate on some of that stuff too. It's a good way. Yeah, I
Or
wish I would have thought about
just
this.
everybody move to Puerto Rico. So.
Oh, where I'm at now. Yeah,
Yeah.
that solves all problems.
Yes, exactly.
Um, I think if I would have done it I would have been a much better investor had I visualized it and done it the way I'm doing now. And I'm very excited about the next several years here. Now, also when you look at the index and we say it's in theory equally weighted index, right? But what also the index allows you to do too is you're becoming intimate with these stocks, and you can eventually weight the portfolio higher on certain stocks that are actually starting to do well and prove they do well. So it doesn't mean I stay equally weighted in these things forever. I mean, I get very big in positions I like a lot as I'm evaluating the index. And there's something about Peter Lynch when he used to do it. He used to buy like a few shares of every stock in the industry, right? Having that look in there, it just forces you to watch the stocks, and it gives you a different perspective on it. But now, if we want to talk about like even another thing we can talk like is RCAT, like as a drone company here, right? Which in retrospect, so remember I said earlier to you that we don't really rebalance this thing right now, right? And I don't know if RCAT when I put it on the index in the 22, I had some reservations of it. And the cool thing about the index is this too, by the way, Bobby, is that because I have so many stocks here, it allows me to go outside the box a little bit, like add some stocks that I probably would never buy, if it was a concentrated portfolio, but like the just in case stuff. And RCAT was one of those. It was on the fine line. I didn't think it was necessarily a highest quality company. I mean, I knew they had some revenue, but I wasn't necessarily impressed with everything they had kind of accomplished yet.
It's been in microcap land for a while.
It has been, yeah,
Yes,
but I liked the chances. I mean, I liked what they're doing, and I said, let me just if there's a drone company I want to have in the index, RCAT would probably be one of the ones I want to put in there just in case it was a
Well, what
situation.
inspired you to think about it? I mean, was it, New Jersey and the drones and all that? Or, what was it? You're like, all right, I think we do need to have some drone exposure now.
Well,
Just
it wasn't like I needed drone exposure when I saw. So a lot of it came into my research funnel through one of my screens, whatever I use, or my things. So then I saw, okay, it seems like maybe they're getting. I mean, I thought at that time they were going to get closer to break even or make some money, which they're still not.
this is
So
back in May, so this is before all that news broke too. So
yeah,
that happened to be happenstance right there, huh?
but the stock went right down. It was one of my worst performers in the index. That's what I want to get to. Is like this stock was down
Oh,
probably
this is 2022. This isn't even 24. Oh, geez.
right.
Okay. Yeah, gotcha.
This thing
Okay.
was probably down 40% at one point, right?
Yeah.
And I did a reevaluation of the index. This is just happening like 3 months ago. I'm talking to Jan. Hey, Jan, should we maybe rebalance the index and take some stocks out, right? And we made a list of maybe 4 or 5 stocks, and RCAT was one of them. And I said, look, we start doing this, we're opening up a Pandora's box of let's stick with the plan. And now it ends up being, the top 3 performer in the index. I don't own it, but it's up 525% now. But most of that return was obviously all of it was this year. So again, I wouldn't have predicted it. So that's what I like. The index it allows me to come up with these wonderful surprises. I don't know if it's going to stay there or what's going to happen when the whole drone hype ends. Unfortunately, I don't think I have any quantum computing stocks in here, which was so
I mean, that's
yeah.
I've been rolling my eyes pretty hard at that, because it's similar to, like, it's not that there won't be applications in the future. We all agree that drone technology, AI, quantum computing. It's not that we're trying to be a bunch of like Scrooges on these amazing breakthrough technologies. It's just we've been doing this for so long, like we know when companies are kind of using the hype machine and how that it's in the news, and then using that to boost their own profile without having real fundamentals to back it up.
Oh, it's crazy right now, dude. It's reminding me of, I don't want to say it. It's reminding me of .com again. It's just out of control right now again.
It's very similar, huh? I mean, I'm not that old, but
no,
I was old as MS MicroCaps, but but
so I'm a little worried about it, but I don't know. I don't care. I'll let it all play out. But it's annoying. It's really annoying.
Yeah.
Super. Because it's gonna end badly for, like, I got a text yesterday from somebody, a friend of mine, who's basically just a casual investor in the stock market. He's, what do you think about these 3 stocks?
Can I guess them? No, I'm not going to guess them, but I'm sure.
But they're in the drone. They're in the industries you think about. Right?
In the quagmire, yes.
Yeah.
In the Bermuda Triangle of like tech hype, yes.
And let me see.
That was good. That was a good line. The Bermuda Triangle of tech hype.
Yeah.
That wasn't bad.
But this is what I said. I said, let me see here.
So there's no dead air.
So I'm like, all right.
Maj is looking at his phone.
Well, there was 2 stocks. They're both losing $100 million a year in income. The only way they'll do well is in a pump and dump campaigns or some temporary rises in this for unforeseen purposes. If you want my opinion, there's no way that a casual investor should be investing in companies that lose money unless it's part of a very big, diverse portfolio where it's only a very small exposure. So that's how I feel. But you have these retail investors. I don't want to use retail. That's the casual investor sees these things, right? And to no fault, they get they see the newsletters out there. They see the hype on media, and they buy them. And it's just annoying because they're going to get hurt in the end.
Yeah.
And when you have a great narrative. Okay, drones, they all sound great names. They're great. You get a contract, stocks go up.
Nuclear, let's throw nuclear in there too. Yeah. That's been getting a lot of hype right now.
Yep. Nuclear, yeah, that had a big run. But the fundamentals matter at some point. The annoying thing is when people are so used to 2015, that past 15 years where you had these overinflated valuations lasting for a long time. .com was pretty fast, right? It wasn't 15 freaking years. It happened, boom, then. So, but now, so you have these army of investors that maybe got involved in the market after 2009 and are used to, 5 years, 10 years of pumping was working. And I don't know if that's going to continue again. But I don't think it is because we're just in a more quality driven environment. But you have a lot of us that if you get involved in the market and you're used to that, it's going to think about like me. It's going to take a lot of unlearning not to. Like for me, my first 20 years, I was used to wave investing, and it changed for the next 15 years. So I had to. It was tough on me to really handle that. Now, investors that got used to the pump and dump, low quality moves, and that worked for them in 15 years. That made me look like an idiot. That might not, they have to unlearn that now, because I think the next 10 years is going to be this strategy I'm explaining here.
Well, this hits on something else when we're thinking about 2024 and the ebbs and flows of the year, and where things were going. Because I think when we were thinking about, when I think back to the beginning of 2024, end of 2023, going into 2024, value was continuing to have its moment, right? People were really focused on fundamentals. Some of these stocks were, on the quality side were really working. And it seemed like as that was happening, people were expecting rates to probably, get cut a little bit. Maybe they're expecting, something to change, presidency, that changing. It seemed like their like risk was starting to kind of creep back in a little bit. And maybe like there was just such a yearning for some of that risk. And especially when, I mean, like I said, the Bermuda, maybe it's the Bermuda Square now if you throw nuclear in. I mean, those four trends, I mean, they hit really at the right time. It seems like between drones, AI, what do we say, nuclear, and what was the third, quantum?
Quantum computing, yeah.
I mean, all of that was kind of happening at the same time, while also mixing in the fact that now maybe investors are coming back to the market a little bit because they want to take more risks, thinking that rates are continuing to go down and down. I don't know if maybe I'm off. Just my
Well,
but there's definitely I think some elements of that happening within the
yeah.
investing psyche this year.
Well, that's perfect too. I like picking stocks, but I'm not a market timer,
Right.
or a macro. But I think it still is important to understand maybe dynamics that are going on, but not spending crazy amount of time on it. But I think that's what's going on, but it shows you that just when you open the door a little bit to the risk on a possibility, look what happens.
Yeah.
These the short term
Nail on the head right there.
nature of investors want it so bad, right? Here's the difference where
Markets want it bad, not just investors.
markets want it bad. I mean, everybody, it's crazy. But what in the end, really, the reason these companies could pump for a long time pre 2022, because it's very simple, man. They had access to capital. Keep raising money and the equity, keep doing the debt, right? You can basically finance your losses forever, and keep these pumps going. Can they do it now? I mean, it seems to be losing them a little bit, but I don't know where that level of how low rates has to get again to go to where it's this risk on everywhere,
Right.
where these pumps are going to last a long time and becomes broad. I don't know what the answer to that question is.
Hundreds of millions of dollars have been raised for a few of these very speculative
it's crazy
names, that you're just like bankers are patting themselves on the back, but I think all of us are looking at like.
And then in the back, it's just we were talking about stock this morning. I mean, I don't know if I should mention the symbol or not, the one I sold and made money on. But it's because I'm ashamed of myself for trading it because but it worked. But they raised money 4 freaking times on this freaking pump, right? And it's like and what bankers are doing, these retail, they're gonna get killed in this thing, and it's still happening, right? They're still able to find that money, but I don't. But I think that when you talk about the round trip we talked about earlier, or the when you look at the Russell 2000 performance, the Russell's had these crazy moves, right?
Crazy.
What you're seeing is I think it's tug of war between those investors who understand that, well, the ones who don't understand, like the rates coming down, we're going to go all in. Russell goes up, right? Which has a lot of low quality companies in the Russell. The Russell's accumulated a lot of low quality companies over the last 15-year bull market. And the smart investors know, wait a second, we're not going to go back to easy money, because the Fed is saying that. The Fed is saying no more freaking easy money like it used to be. We're been telling us that. But every time the market doesn't believe them, it goes up and then they remind it comes back down. The smart investors are selling that shit, and eventually, as I've written about, Bobby, is that these zombie companies will fall out of the index, out of the Russell, for example. And these companies we're looking at here, eventually, like TSI, basically is on the NASDAQ now. These higher quality will replace the Russell. So I think the smart investors know that. And yeah, that's why you see the Russell like this. Like you had the Trump rally, and now we're back to basically it came back to where it started. It's people if you're smart, yeah, I don't want to say you're smart. If you have an open mind, you'll understand that that could be going on, that transition. And what the beautiful thing about that transition, though, which is why I think we're in a long-term bull market in the strategy we're talking about here, and which I've been talking since 2022, that process of replacing the Russell, it's going to take a long time. And I don't think the most of the market investors have even seen these stocks, have figured it out yet. And that the bull market really for these stocks is going to be unbelievable when the rest of the market when the everyday investor, you start to see some of it happen when they start seeing when these are the stocks they're buying, right? When these are the ones they start seeing on the new high list and keep buying them. You know, and before 2022, the new high list in momentum screens were dominated with those shitty companies. You're going to start seeing these great companies dominating those monthly end movers and the big movers and the new high list. And that's you're going to start seeing more investors come into these stocks. And as that happens, in this long-term bull market, I think I hate saying predictions, but I think 10, 15 years, you of course have corrections and crashes here and there, but I think that you're going to see this as long as rates stay normalized. I think you'll have this opportunity to see a long-term bull market. Now, I don't know what's going to with Trump right now in office. I don't know what he's going to do. I don't know what the Fed policy is going to be when he's there. But going into this, transitioning into this whole Trump thing is like you have this now really interesting setup here where if rates do stay normalized and you have an administration that can get things passed, I don't know, maybe they can. Um, you might have a period of time where everything freaking works. I don't know, pump and dumps and quality. I don't know. But I'm just happy that quality is back personally. And the most frustrating thing prior to what we're seeing now is that uh, is you would have these moments of moments of outperformance by smaller caps during '08 and 22. Well, let's take out COVID between '08 and 20. But it wouldn't last. You get all excited, oh, yeah, they're back, and then there would be, remember those times? Mm-hmm. You'd have like a 4 or 5 days of a performance in the small stuff, and it would just stop. And this is the first year, I think, since then, where you've had momentum across the board. Now, between that time at 15 and 22, being a concentrated investor was really good. Diversification didn't work as well then. You couldn't own all these stocks. You had to own the best of breed, which was challenged. And there were some investors who did great in those time periods. They were concentrated. So, but that's why I think we are set up right now for a pretty nice little bull market going on. So I wanted to show you because we were talking about we were off this podcast. Are we going to combine Geo and MS? And it's possible, but I just wanted to show you because I get the question all the time, like what is Geo and what is MS? How are they different? Because I'm going to transition now into Geo for a second too to show what's going on there, which is also proven that quality is working. So the MS index really is the GARP pipeline of Geo. That's what the index is, and you'll see a lot of cross-pollination there. But as you can see, everything that Geo does here, it's a lot, more. We do monthly forums, we do morning emails, we do a weekly update newsletter. We have pictures from contributors. We have different model portfolios. We have screens. So there's a lot of stuff going on there, right? And then MS really is focused on the index and cliff notes. But there is some stuff that is shared by both the focus on quality, interviewing investors, management interviews, community. So we're right now. What I tell people is this: if you just want to dig deep into stocks, do your research. You want a hunting ground, and that's all you want. I mean, MS might be good enough for you. If you want some more engagement with us on a daily basis, weekly basis, the monthly forums, where we dive into some of these stocks a little more, in that fashion, you'll enjoy Geo. Um, for those that love research, I think you get the best bang for your buck with Geo and MS. For those that just want like, hey, I just want to, I mean, I don't want to say, I hate we saying stock picks, but we have model portfolios in Geo. And if you don't want to do a lot of research, maybe you use those and Geo is enough. So that's, it's, and we right now we are talking about like how to, make these things work together. So if I just want to, we get that question all the time. But yeah, we both have monthly plans. So if you want to check it out, just go for a month and just see if you like how you get a month out of it. $30 a month. And if you don't like it, leave. If you like it, stay. And
So,
or maybe you want one of them, the other one. That's the best way to figure it out.
gotcha. So, all right. So, very cool. Wanted to ask you one thing on quality because, we talk
Yeah.
about quality. We've talked about quality probably since the first time we did an interview back in 2015, right? How do you feel that quality has been redefined at all here in 2024 or at any given time in the last, year or so? And if so, how should we then think about quality and when you're looking at potential investments here?
Yeah, I don't know the change. I think the way I look at it, here's how I look at it, um, the quality piece, because I don't know if it's changed, Bobby. I just know that I know I have a 10 point list of quality we're looking for.
Right.
And I just know when I'm looking at that quality, those checkpoints, what matters the most to me. There's two things that kind of, when you look at the index, that really are defining the most important parts of quality right now, I think. And I think it's really capital structure. When I look at quality, I look at capital structure. Does this company have liquidity in the balance sheet to be able to grow without diluting shareholders? That's so important. It's proven over and over and over again. That's one piece of it. And then, so that's number 9 and 10 of our quality list. Not a lot of dilution, history dilution, and not a lot of outstanding shares. That's number 9, 10. Number one on that list is looking at companies that have been around for a long time. So there's a lot of quality companies that end up being in that bucket because like been around 40, 50, 30 years that they have a customer base, they have a product probably. Maybe they're not hitting multi-bagger markers yet, but we monitor them to see when they do. When you look at the index, most of those stocks in the index have been around for a very long time. We're not really and so I think to me, if you say what it has changed over time, right, is that because everybody is so short term now, when you have the investor holding period for the everyday investor has gone from 6 years to 6 months, maybe less. What happens? New companies that come out have to basically cater to that. So I'm not quite sure that they're looking as the same way, and on the long term perspective as a company has been doing that for years. That's what they are, right? So that's why I think any investor, if you really just go through the stocks out there and you look at these stocks that are at least 30 years old and use that as your first kind of marker, I think your odds of success are going to increase, I think, tremendously, personally, on a long-term basis. Now you see some of these guys, these CEOs they're like in their 70s and their 80s, and they still have this weird kind of understanding of what maximizing shareholder value really means, like the essence of it. I don't know if you've found that much. You don't find that as much in some of the newer companies, in my experience. And I think that is really important. Now, the other pieces of the quality are, of course, revenue, profitability, balance sheet, insider ownership, the usual stuff. But those two things, how long have we been around, capital structure, really are important to me. And and what you'll find a lot of these older school companies redefining themselves through, and we look for them when they hit multi-bagger markers. And what could happen, what does happen sometimes in these older school companies is because they are so old school and they don't have a short-term thinking necessarily. They get comfortable, right? Sometimes they do need an activist to come along or something to come along to maybe um, figure out how to start growing the company with what they got. But they have great assets already and great um, uh, canvas to grow from. You know, TSI is a great example, right? I mean, TSI had a great asset. I mean, when the first when he came in, Anthony came in originally, he basically gutted the company, sold the construction piece of the business and saw this little integration business. And he grew that, right? He saw that asset there, and he had a great customer. So he basically cultivated that. They had a reputation already, and he found a way to change things to really make that work. When you look at LFVN, which was one we showed you today, LifeVantage, which was they've been around for a long time. It's an MLM company. I don't love MLM companies, but Dayton Judd on the board now. I thought that was from FitLife. So that was
interesting. I didn't know
that was pretty cool. They went through an activist
Yeah.
battle. That's a cool one to talk about now we're on that topic, because LFVN is a really cool combination of some of these things. You have it's coming around for a long time, an activist, on board with Dayton Judd, great experience, right, with FitLife, like a multi-bagger specialist with FitLife. But they weren't growing really, and the activists were getting involved because the company basically, which sells all these like healthcare kind of over products, weight management, skincare management things. When you see a lot of these MLM companies, they face a growth, they get to a point where they can't grow anymore as much. So they were trying to figure out how to grow the company. And activists come in, and lo and behold, what these guys do, by the way, they I guess they call it the activation company. They make things where your body activates something, right, or they're a hormone or whatever to create the effect, the benefit effect, whether it's collagen or in this case was GLP-1, which is a weight loss product. Ozempic. Is that what it's called? I think it's
Ozempic.
Ozempic, yes, yeah.
The GLP-1.
So it was funny. I was listening to, so I knew about LFVN, and stock was like maybe $5-6. And we already bought it when the stock had fallen, when the activists lost their first battle to get involved in the company. But then, so all those stocks who got into it because of the activist optimism sold. That was my opportunity to enter. I think I got as low as 3 or 4 actually. So that's when we bought it. We put it on one of our buy and pullback portfolios. So we're going to get into this in a second here. So we have a model portfolio we call the buy and pullback, the BOPs. These are stocks that fall for the wrong reasons, and we put them about maybe 4 to 8 stocks, and we create a model portfolio because we think those stocks are going to come back to where they fell from and maybe even go further. So we put it in the model portfolios. I owned a little bit of stock. I still own a little bit of it, I believe. And so I knew the whole story was kind of going on. It was a small position though of mine, and I'm listening to a Wall Street Journal podcast. And who is it? Is it Lilly? They're one of the GLP guys, I think. Yeah. And the CEO is on this Wall Street Journal podcast, and they're talking about GLP-1. Like, wow, okay, interesting. And then, so that's when I really first learned about it. I mean, I was so ignorant. I didn't even know what was going on in the whole thing. So this is all this year. This is early this year. So then I noticed that not too long after that, I mean, almost immediately after that, LifeVantage puts out a press release about hosting a virtual event for their distributors where they're going to be talking about some new products. I'm like, okay, that's interesting. So I found the video on YouTube, yeah, at some point, and buried in the YouTube, buried in it, like well into it, he addresses the new product. And he first time mentions GLP-1 product. Uh-oh. So that was the information arbitrage we talk about, the info arb. So this is information we found. I don't think most investors are going to see that, right? And the stock was still sitting at $6 that time. We put it in the buy and pull back portfolio. I think we actually already had it in the portfolio, and that catalyzed it. But it took a good, this is going on. We're talking about it on Geo. I mean, it must have taken, that was in July. It took all of July, all of August, really, for investors to really figure. There was no social media posting thing at all for like a month and a half. It's crazy, right? And then eventually we interviewed them on Geo. They put a press release out, and it was now the stock's like 17, $18. That is a perfect example of InfoArb. It actually had a low PE. I mean, the stock was, it was like if you want to call deep, maybe it was deep value at one point, for a reason. But that was a great situation of InfoArb, buy and pull back. It's the essence of the advantages you get by investing in microcaps. You don't get that opportunity anywhere else, right? I mean, it's crazy. I couldn't believe it. And I think it's actually getting worse. I think it's getting easier and easier. I think these nanos and microcaps are getting more inefficient. These illiquid guys, no one wants them, at first. But you can't deny, and at some point, if you find real information, it's going to affect the balance sheet and affect the income statement possibly. Boom. So that's a good example of what we were talking about earlier. I even forgot where I went this tangent.
buy and pull back quality, perfect.
Quality.
Yeah.
This is a quality company. It's very profitable. Just wasn't growing. So the key really, everyone talks about profitability, blah 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 blah, right? You need more. You need to find profitable companies, or those that are close to profitability, that are going into a multi-bagger, if you want the best return, right? The maximized alpha you want to get, find those companies when they're going to go into a new period of growth. LFVN is a perfect example of that over and over again. That's how we get the alpha we get. Now, you can get alpha by probably just investing in profitable companies, right? But you get the most alpha, in my opinion. And I think by finding those that are actually going through absurd or new growth, new periods of growth, where the PE ratios have to re-rate higher because of that. Mm-hmm. That's really important. And that's why the index that we have is quantitative. We're looking at the numbers, but qualitative, which is hard for robots to find. You got to do the hard work, read the transcripts, read the filings, presentations. I have a team now I've hired actually that's helping me do that now. I've outsourced. I think the opportunity is so freaking big that I'm expanding the info art part of my team right now. Mm-hmm. I'm actually writing software now too. It's to a point where it's getting too egregious not to start spending money to exploit it. Mm-hmm. And that is one example. I mean, how the frick does a stock sit there that's already had a PE of like maybe 8 or 9, if that, I think it was maybe 7. You're sitting there already with a new growth plan intact, even without GLP. Okay. And boom. A lot of it too comes to this, Bobby, is that and this is something I'm unpacking a lot of stuff we talked about this year, is that when you look at investing, part of the really, I think he also in generating alpha early is believing too. We can go into a story with a half glass empty or half glass full. I think a lot of investors go into investing like, I don't want to believe anything management says, right? But
for good reason in many respects, but we get.
But I think once you've concentrated on that number one piece of it, like the ones that have been around for a long time, and the ones that have proven that they have not diluted a lot, I'm willing to give them maybe the benefit of the doubt. So that's why, like an LFVN, it just takes forever for investors to understand. We bought LFVN before they made the official announcement, right, on a press release, before they've even put any revenue from this thing. But you just know as an investor that once it gets out, this thing's going to get some hype. Now the hard part begins. Now it's $18. Are they going to grow it? So but I think when you give the management the benefit of the doubt on a high quality area of the space, you're going to be able to get cash alpha because you believe it. And that's a really important point I wanted to make. And that's kind of what I've done. That's why diversification allows you to do that, because you can be wrong. But if you're investing in these quality companies and you want to trust them, I don't believe all CEOs want to fuck us. I don't believe they all. I think a lot of them generally do want to, do well. You have the ones that want to do well, that can do well. You have the ones that want to do well, that can't do well, and you have the ones that just lie to you. They're just all there, right? And you got to figure out.
I will 100% agree with you that I'd say 80 to 90% of the CEOs are in that first two buckets. It's rare that it's ones that are just straight up, shysters. Yeah. It is, but at the end, but on the first two fronts, like most of them are there. And having interviewed thousands of CEOs now at this point, and 80 to 90% of them have the right intentions in mind. They either can do it, they eventually do it, or they try their best in whatever capacity they were in, and it just didn't work out.
It's right? Also this though, Bobby, too. So let's say we take bucket one as the ones who.
By the way, hold on real quick. I just want to acknowledge Maj was cooking. Like that, this is why I love having Maj on. Like when he just cooks for about 15, 20 minutes, it's just a beautiful thing. Anyway, sorry, you were saying.
It's hot in here.
Yeah.
AC's not working.
You're Puerto Rico too.
Let's talk about the buckets again. So bucket one is the CEO that makes the promises, that succeeds. Okay, they work it out, and the bucket three is a fraud. The bucket two is really the hardest part for the investor. Really, it's that CEO who wants to do well, who might have an interesting product plan, and fails for certain reasons. You could fail for misexecution of your plan. A lot of time that occurs in the inability to scale and inability to have a marketing plan. So, but part of it is. There is that unfortunate. I call them the dreamers. The dreamers. They just don't understand capital markets. They don't. They might have a great idea, interesting idea. Maybe they shouldn't went public yet, or maybe the company should be public. Whatever it is, they don't understand capital structure and how important it is to grow in the company. If I have to hear one more CEO tell me, I want to put a fucking shelf out there for the just in case moment because. An investment bank told me I should and showed me a study of how it works. Grow the fuck up. Of course you're going to tell you that. I'll show you a company that did it right. And, you're going to get penalized. And they don't understand that. And it's unfortunate to me. And there are even investors out there that I disagree wholeheartedly with, is that I think that the market is there so you can raise capital. I think you are public to maximize shareholder value, right? That's the first fucking thing. And use capital the right way to do that. And you're never going to tell me that sitting there with a shelf sitting out there, is the right, for most companies, there are some that can get away with it. I'm not going to say forever, right? And unfortunately, every CEO thinks they're that company. Every CEO thinks I'm the difference. I'm the one where it's not going to freaking matter. And it doesn't matter. I was having a conversation today with somebody. This stock isn't going up. They made an acquisition. They have a low PE. I said, well, they got a shelf out there for fucking 2 years. And they haven't even freaking used it. But it's just sitting there. Right?
That everybody, any savvy investor knows that, like, okay, if it gets here, it's going to be triggered. Yeah.
Well, maybe not. But that's what we're thinking. You're going to get a discount for that. Look, if we look at one on TATT, which
shareholder.
Is
Still shareholder.
Not enough. No, thank you for that freaking. Now wait, I am gonna before I get in trouble by you. Hold on, I'm gonna text my trader here.
So that there's no dead air. Maj is texting his trader just to make sure he is still a shareholder or not in
Yeah.
TATT.
I think it's a very small amount, which is, unfortunately. I didn't have buying power. It was all on TSI at that time. I could not But so this company is an Israeli company.
So you do
They
own,
are
so you
as
don't just clearing it up. You do own a little bit.
I'm
TATT.
still waiting.
So wait, okay,
Once
all
I
right.
get it in here,
Gotcha,
I'll
gotcha.
drop
Okay,
I'll drop
gotcha.
it.
Okay.
And I think we added it to the index maybe around maybe $10, $11, whatever. I think it's 26 bucks, $24 today. It, this and while I do this, I'm going to get into how they raised money, okay? But again, this is another great case study of how this tier one quality company turns into a multi-bagger. So it's not enough these guys have been for a long time. These guys make equipment from the aerospace industry, but what they did along the way is they introduced a new business line to give them more of a recurring revenue stream. So they're working like they have a maintenance piece of the business that Boeing and those guys hire them for. So and they're long-term contracts. They went from this lumpy revenue company, lumpy revenue-ish, to high margin potential recurring revenue from these maintenance things. You're seeing a lot of that, by the way, happening in the like boring companies. That was the multi-bagger factor we noticed, and that was all it took. And so that was an example of the stock was sitting there doing nothing for a while, for years going down. That one aha moment was the reason to put it in the index. And it was just put in the index, and I think in 24. It's up over. It's one of the multi-baggers. But and I use these guys all as a case study all the time. I don't own TATT, by the way. God damn it. So yeah, I don't. But it is in one of our model portfolios. I'll say that. So there you go. Maybe some of my members do. But they raised money a lot, like 2 or 3 times, small, along the way through private placements, through investors, that close to the company, without putting a shelf out. And they did it in a 2 or 3 steps to do it, right? So if you're going to basically raise a small amount of money, to me, there's no reason to do it. To have a shelf out there. If you are now, look, if you are a trouble company, I'm not saying if you are a shitty company, you need a shelf, put it out there by all means. Pump your stock, raise your money. But you're coming back, your stock's coming back down. But if you're a high quality company, wait that last second to maximize what you can get and try and time that raise with your event. Okay, so don't sit there for this, please. If while I hear from the CEO, we need to be ready to strike. Look, if you find a company that you believe are going to be synergistic together, they'll wait your 6 weeks to get your freaking shelf out there. I'm sure there's a way to do it. Hey, make sure when you announce that shelf, say, put in the shelf out because we're going to acquire a company, blah, blah. That to me is the best way of doing it. And if you have a true partner, they'll wait. So that's how I feel about that. And I think because the capital structure is so important to a company, it's where that bucket two, those bucket two companies fail. They fail understanding how important that is, really, and they ruin it.
One of my things that I'd like to see more in 2025 is, look, there's quite a few of these companies you come across, I've come across, they're going to need growth capital in order to execute on some of their business plans, right? I'd say probably 50 to 60% of them will likely need that. What I would like to see is, really embracing alternatives to doing a shelf. Whether that's having that strategic, anchor investor, anchor fund that, already owns 5-10%, something like that, can come in, they can do, some kind of, private placement, be the lead in a private placement and are able to help in putting that group together and doing it like that. Because, when it comes to the banks, unless it's a higher tier quality bank, we know which ones those are, then it's a kind of a different conversation. But even then, it's sometimes like you got to be careful. But yeah,
totally agree. Put it in strong hands. Dude, I mean,
put it in strong hands. That's it.
These offerings are like, I'll get the call. Hey, do me a favor, just do it. You can sell it later. They're not in strong hands. and it's really annoying. So alternative ways of doing it, pipes with strong hands, maybe your own investor base. When you do an acquisition, maybe you just give stock to the company, as opposed to issuing stock. I don't know. Yeah, there's just there's different ways of doing it and different approaches, and then the timing of how you do it and looking at different ways you can do it. So are important. So we go back to the buy and pullback. So the buy and pullback portfolio really is the essence of MicroCap investing. It really is, because it really flushes out the ignorance that a lot of the MicroCap haters have, or the people don't understand. It just basically shows all the advantages. Info arb, right? Because you're basically flushing out information that the market doesn't understand because these stocks are falling. So you only have the opportunity to a large extent in these smaller companies, because you're not going to have as well as an edge finding info arb and Apple and Dell and those bigger other stocks, right? So it flushes that out. It flushes out it just shows you the alpha you can get in the space. So as we know from O'Shaughnessy and other type of studies out there, MicroCaps just over the long run beat the market. So you already have that alpha. Okay, that 8 whatever percent alpha a year that O'Shaughnessy said that the small cap, the smallest SL companies have over larger SL over time. That's pretty big alpha over time. Then when you add to it the misinformation in the space and these pullback opportunities, it creates even more alpha opportunity. So you have the buy and pullback portfolios that we put here, model portfolios, already has the MicroCap advantage, right? And it adds to the advantage confusion when stocks are falling. It's a beautiful thing. We've had 12 of these portfolios. We're in our 12th portfolio right now, 12 of these. So we launched our first one, I think, in February of 2016. Out of 12, 10 have outperformed the market. And I think it's something they all did, but when we close, we keep them open for about 3 months, 9 to 12 months. Upon closing of them, one's still open now, but 9 out of 12 beat. We have one open right now, it's beating. So when you look at the returns, and so you look at this one here, which is our more recent one, and this is part of, I'm not doing this to brag, I'm just to show quality is working, and a recap of the year how quality works, right, and how all these strategies work together. Now, when you look at the positions as of 12, 26, 24, 37% is the return of those stocks. There's 8 stocks in this portfolio right now. They're still open right now. So that's why the current return is basically a position that they're all open. We call the real return is the positions that are open plus the ones we close. So right now, all of them are still open, so that's why the returns are the same. And as you can see, since we launched the portfolio in September of this year, it's up 37%. Basically crushing the indexes from anywhere that have been up anywhere from 10% to 20%. Now I took you earlier from on a diversification in the index. Now these are more concentrated portfolios, which I can show you also. When you have the strategy of quality working, you can do diversification or concentrated. Pick your poison. You just have to be hunting from the right universe is really the key. But you can see here, and then if you look at the top performers here are PSIX, which I do own, FEIM, which I do own, frequency, and OSPN. I'm going to check on that, Bobby. So you can see these are all up 148%. 55% and 27% respectively are the top performers. The bottom performers.
Yeah, PSIX had some FinTwit love not that long ago.
It's amazing. That's an InfoArb, by the way. I'm gonna get that in a second.
Yeah.
Over here you had on the bottom ones you have 14% on Band, Quick 11% up, and GNC down 6% on the worst ones. So PSIX, by the way, is a a value trap was a value trap stock. This stock was, I think, $2-3 a year ago or so. And they make engines, but they also make this encasement product to protect generators, and they're selling them in data centers right now. So that was the fuel that got a lot of this going. So, but that was a little info arb in that. You had to really catch that in the release and but anyways, FEIM was a really cool info arb opportunity. So FEIM, and my tweet thread today, by the way, you can look at my tweet on the Geoinvesting tweet at Geoinvesting. We put a thread out on info arb, and FEIM was one of them. And this is a great example of how info arb works in the smaller cap space. These guys make control products, and I think power control, signal control products, and communication, satellites, and they've had a long history of underperformance. And part of the issue with them was low margin backlog and inability to complete projects on time. New CEO comes in, new play, changes the backlog, blah blah, changes the way they do internet contracts, so they can have ability to maybe change the, if things are working, maybe increase some of the fees during the contract span, whatever it might be. But in the conference call, second quarter of last year, right? I think it was last year. They have a weird year, a year ago. They mentioned in the conference call that their gross margins were going to go from 30% to 50%, which is huge, right? But that was only mentioned in the conference call. Stock now is up over 100% since then. So I mean, but that's the stock sat flatlining forever on that, because no one believed them, right? That's one thing. If you believe them, you buy it on that news. You buy a little bit. You buy a little bit. That's why maybe you don't put a big position. And then the plan made sense. Well, guess what? They just hit. And now they just put their earnings out a few weeks ago. Stock ripped, 49% gross margins. They got there. And if you did the math, okay, and when you modeled that backlog, which they basically fill every 12 to 18 months, really 12 months, you can easily calculate the earnings per share run rate on what that would look like if they hit 50% gross margins. And it was pretty amazing. So the stock, you had a close to $2 in earnings per share potential. The stock was selling at $10. And that was enough to place a bet for me, and put it in. Actually, this is also in the index too, the MSMqi index. Still waiting for OSPN, by the way, Bobby, from my boy.
By the way, I have to ask. I looked at your tweet thread. Did you look at the NXTN stock today?
No.
Take a look real quick.
Let's see. Oh no. Oh no. Don't tell me it freaking
Popped pretty hard.
Oh, that was yesterday, right?
Was that yesterday? Oh, the 26th. Oh, yeah, that was yesterday.
Thank God. I don't feel buying this thing yet. Yes.
Pops over 1,000% on 100 shares. Wow.
That's why I noticed it, because yesterday, yeah.
Yeah, my goodness.
Has a big bid and ask spread. I might actually own a piece of that too. Now I gotta talk about that too. Hold on a second. Do I own any of that?
You mentioned the thread. I was looking at it. I'm like, what is this NXTN? I never heard of it. And then I was like, oh my goodness, what is going on here?
Once he gets back to me, I'm going to get you on all those stocks. All right.
Okay, gotcha.
But all these stocks have fallen. BAN was a ridiculous one. BAN beat estimates, everything. It went down like 30%. Like, come on. Okay, we're going to go all over that. And the other thing is, with this model portfolio, I can't wait. I can't sit there and do analysis for 10 years. Because the stocks are dipping. I got to make a quick decision. Is it worth getting into or not? The cool thing too,
band round tripped a little bit, huh?
Yeah, well, it went down, up, down, up, down, now back up, now a little bit down again. But so it's all over the place.
Yeah.
They do some. They offer connectivity services to cloud communication companies, basically. What they do. So, all right. So let's move on here, and I'll show you here. This is number I want to go here actually first. This is a bug. This is buy and pullback number 11. The one we had before was open for about a year or so, 925.23 to 913. And as you can see, that had 7 stocks with an average return of 84.69% at close. Crushed all the markets here, anywhere from.
How do you pick your dates on when to, because I'm sure some people might watch this and be like, oh, that was convenient. Close it for, right there. Like, wow, yeah, look at your return, 80. Wow, that was nice timing there, Maj. So like, how do you start thinking about the dates when you're putting together some of the data here?
Well,
So,
if you look at that, you should be saying, man, Maj, you suck, because if you look at the return over here, 84.69, that's if we didn't close any of the positions. Still,
Oh, I see. Okay. And then the real returns right there. Got it.
right
Okay.
there. So I bad portfolio manager. So you can see how
That's it.
that's why this thing is
I'm pulling
smart,
my
man.
fund. I'm pulling my funds. Okay.
That's why I like the whole like let it all ride, right? Let them.
Sure.
But that shows you an example of that whole thing there. Um, and so if we go here to the focus stocks, so this is another one of our model portfolios. So I decided to do was we cover over 1,500 stocks in our universe. So I figured, why don't I have more of a longer term portfolio? So the BOP model portfolio is more that short term, 3 month to a year kind of thing. Can I find alpha in that period of time with that strategy? The focus stocks is more of a, can I find stocks that are going to grow at least 50% in the short term and multi-bag long term? That's kind of the focus there. And
And
every month on Geo, we do a monthly forum update where we talk about the whole universe. And I try and find one stock, my favorite stock of the month. That's what that is basically, or our team.
by the way, anybody who's listened to the pod this far, you're right on your way to becoming an info arb expert in having listened to every word that we've said.
and, so here's the focus stocks here. If all positions are open, 37%. This one over here, we closed one at a high, so that's why that one's higher, 58%, because we actually closed them before it fell. So did a better job there with that one. But as you can see, these are also beating the markets by a wide margin, anywhere from 37% on the current returns versus 8.8 to 23%. And 58% is really crushing it, right? So if you look at the top holders here, I own ACFN, I own PSIX, I own KLNG, so you know that, Bobby. The bottom performers, I own those all too, FACO, CVLF, and MLJO. So I wanted to show both. And how even if we have bad performers, we can still put up good returns. It's the way the math works, right? And when we're trying to find these high performing stocks. ACFN, you want to talk info arb again?
ACFN, that's been a fin twit. That's
Yeah.
actually, I think, been the either top 5 requested company for Vegas this year. So yeah, let's hear it.
It should be. And by the way, that is also in the tweet thread today.
Oh yeah, it is in the tweet thread.
This is a very simple one. So for all of you who don't know ACFN makes sensors that are put into well, I don't know what, modules or products to basically monitor them. And a lot of them right now are used like in generators to monitor generators or other power assets. They recently got a contract. 50% of their company revenue is hardware revenue, like the sensors. Maybe I think they might even a box too or something, a monitor they sell. And the other part is the recurring revenue of monitoring revenue, which is, so that's the more profitable revenue over time. They just early this year, I think maybe August or so, they announced a contract with a wireless company, telecom company, to monitor their towers. All these towers need generators, and so you need to monitor the power in the generators, obviously. So they got a contract to put their sensors in those assets. So we didn't really give the model. I mean, I think it was like a $5 million contract, whatever. But we listened to the Q2 conference call. Oh, we actually read the transcript, and we noticed an exchange between an investor and the CEO about what the model might look like. And they flushed out the model. And by doing that, you're able to pretty confidently figure out the earnings per share number for the third quarter coming up and future quarters. And that was going to be a huge breakout. If you know the ACFN story, everyone's been waiting for a long time for this company to break out the profitability. And that Q2 told us that Q3 was going to be a breakout. So we had estimated 24 cents, 22 cents for the quarter. They came in at 29 cents. So that just shows you how if you were next stock didn't freaking move, did not move after Q2 numbers and then transfer. We brought the CEO Jan Loeb on our podcast at Geo to basically flush out that conversation that was on the transcript. We saw the transcript. Let's get him on the show and talk to him a little bit. And we understood, wow, that's pretty interesting. And then we were able to build a model internally for the next 8 quarters or so. And looking pretty good. So we think they're going to continue to have home run numbers. There is some info wire, by the way, I'm not going to talk about now, but home run numbers moving forward in ACFN here too. So that's another great. Come on, man, get back to me. Where is he? Where
It's on vacation too, man. I mean, we are recording this on Friday, December 27th, like I said at the top. But you know,
you couldn't wait till January 2nd, could you? To get the real returns for December in.
I offered it. I said we could record this on Monday at least. You know, we got to get on our our end of year pod. But so
that's the presentation basically. I mean,
yeah. So then I think we've pretty much covered most of everything that I wanted to talk about, from round tripping and reflecting on 2024, spotting real winners. I mean, in the game of hype. I mean, we've covered quite a bit in all of that. And I don't want you to pass out while you're on here. So, I figured, let's kind of close up, and now that we've reflected on 2024, looking ahead at 2025, I mean, you kind of already alluded to that. You're going to be really even more focused on InfoArb in 2025. But what other trends or things that you're looking at that, aside from always trying to find quality where others aren't looking, what are some other things that are top of mind that you think others should also be looking at too?
I'm gonna really ratchet up my look for some of these companies that are. I want to have a little bit of fun in 25. So look for some of these companies that are not quite profitable yet. Maybe they're one or two away. And I want to see if I can identify some really nice multi-bagger potential, because those are the ones you can get really awesome multi-baggers on because no one's looking at them yet. So I really want to focus on that. I'm going to focus heavily on stocks trading under, the run to one portfolio, because they're heavily ignored. I want to I believe the market is still inefficient, but I think it's going to get a little more efficient because of the success that's happening in the space that we're in. It's going to attract more investors. So I need to dig a little deeper to get an edge, right? So I figure InfoArb is a great way to do that, and hunting in places that a lot of investors are going to ignore, and that's in these stocks trading under $1 or so. Of course, I'm going to not just exclusively hunt there, but I'm going to just today, yes, a few days, we just dropped a cliff note on a new InfoArb play. On the cliff note, I can't see a symbol yet, but I'm still flushing I'm still flushing it out. But if you want the symbol, it's on our Substack. But this is a classic, fucking classic. You ready for this? And
Let's go.
This is the early of 25. So this is a company. I'm not going to say what they do, but information in a press release, hints of a new product line. Just a small little hint. Their legacy business is already turning profitable from losses. It's overvalued. The stock doesn't look undervalued. Go to the conference call transcript. Talks about a little more. And then you go to the SEC filing, and there's a section in the SEC filing called subsequent events. It's basically information that a company provides in the filing between when the quarter ended and the filing of the report, right? So if a quarter ends June and June 30th, maybe they put out their report in mid July. If something happened at that time, the thing is material, they'll put it in that. They might not put a press release either, by the way. That's the key. So you're looking for these subsequent event kind of things where there's nothing disclosed yet. So we always look at those areas in the filings. And in the filing, it said they just won a $5 million contract on this new line of business. It's a licensing business, like a license selling data, with a $3 million option just to increase it. And the key question is, okay, well, is this going to be recurring? Well, when you go read the commercial transcript, you find out, well, it looks like this business is going to be a very significant piece of the business. And that's where the half glass full empty thing is. Do you buy it on that? Or do you? So we published a report on that with that caveat. So when you work out the numbers, and this is going to probably high gross margin, over 90% gross margin, as I'm thinking, their EPS on a sequential basis is going to try to triple from maybe like 10 cents to over, to maybe close to 40 cents for the one quarter. Stock selling around $7. Now, if you start building this model out where, okay, if they get more of these, if they get one of these a quarter, wow, this thing's going to just go crazy. So that's basically, you basically have you will never, ever, I don't think, see a significant contract tucked away in a subsequent event filing of Apple without it being in the press release, right? I mean, and I was just going to say this, hands down. That's why, I believe a subscription, Geo and MS and the team that we're building is really special. Not just amongst our members, by the way. I mean, I got that idea from one of our Substack subscribers. And he flushed it out for me. So we are building, I think, a great community of really info arb specialists here. And that's you go through. I've been doing now Geo 15, 16 years. And what you do with any business, you try to reflect back. Okay, what do you do good? What do you do bad? I mean, I know I do bad. There's a lot of that. What do we, but what do we do good? And I think what we do really good is that it's just basically our edge. It's our edge of not only we just enjoy it too. And when we do that, we start building a community of investors that also appreciate that edge and maybe do it themselves. So we all, kind of bond a little bit. And I'm really, really feeling good about how that's going to, progress. So,
heck yeah.
InfoArb all the way 2025.
The year of the InfoArb.
Investing in stocks everyone hates under run to ones, right? That's going to be, and I'm definitely highly focused. U.S. and Canada are still where I'm going to be focusing on those two markets. Really,
plenty of opportunity there, that's for sure.
Yeah,
well, Maj, this has been great, dude. I think this is our new record. I think we're close to 2 hours. We did or more.
Cut it up, baby.
Yeah, we did. No, we post the whole thing. You know that. So, Maj, where can folks go and subscribe to MS MicroCaps as well as Geoinvesting?
Yeah, so you can follow my Twitter handle at Maj Geoinvesting, where I talk about all the stuff on both platforms here and there. At Geoinvesting is where you can do that for Twitter, and at MS MicroCaps on for my Twitter handle for that one. And I am by the way, I'm launching my new press release product any day. I mean, I know I've been teasing you about that for 10 years.
Yep.
But it is coming out. So
very cool.
It's working pretty cool.
I love it. Well, Maj, just again, Happy New Year, man. It's always a pleasure having you on here and chucking it up a little bit, and wish you and the team great 2025, and I'm sure we'll see you in Vegas. So I'll see you soon.
All right, thanks, brother.
Thanks.
Have a good year.
You too.